What's up, everybody? Welcome to the first edition of the 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by Indy Wealth. We're going to get right into the hot button topics as we enter into 2026, so let's get going. First off, let's talk about Venezuela and the markets. We saw the markets are actually up this morning. The oil stocks are actually reacting fairly positively as the military action in Venezuela to remove the president is being looked at as rebuilding of an infrastructure in the oil landscape in an oil-rich country like Venezuela. So that is probably the biggest predominance that we're seeing for action that is directly related to this. The market doesn't seem to think that there's going to be a lot of contagion effect because I think that's what you would see a worry of. If you really saw a down market and things like that, you would see that the market probably would be assessing that, hey, this probably isn't done, or the occupation component or the leadership component could take a while and bring us into a morass. And are we going to do this in other areas? The market and investors right now don't seem to be putting that in the forefront of their mind. They're much more, markets are positive again, as I said today, and oil prices and oil companies, especially Chevron, who already had a presence there, and Exxon to a certain extent too, are looked at as the primary beneficiaries, and some of the service companies like Halliburton, as well as if you install new leadership and you develop infrastructure, the companies will benefit from that transition. From an investable point of view and what we're doing on our side, it's, to be honest with you, not much. It's much more analyzing, monitoring, paying attention, no action from this. So from my side, we don't really take a lot of stances with regard to political action creating portfolio action. It tends to be, a lot of those movements tend to be short-lived. If there is contagion effect, it usually is something down the road that changes, that either accelerates that progression or adds a new element that we didn't see coming. So trying to predict that ahead of time is extraordinarily difficult, not something we recommend doing. So from a portfolio perspective, again, we'll pay attention, we'll understand what's going on, we'll monitor, but we're not really taking a lot of action in our portfolios right now. Turning to number two, we're going to have a jobs report on Friday. And this is kind of the first one that's, well, I wouldn't say it's completely clear, but it's a little less muddy. So this will be interesting. Right now, the jobs estimate are for 55,000, which is a pretty slow growth. I mean, that is very slow growth. It's growth. It's growth in the job market, but when jobs added is always better than jobs declined. But 55,000 is relatively muted growth. Now, we'll see where the number ends up. That's just the estimate. So we'll see where the final number ends up. There is an estimate. So unemployment hit 4.6% in November. There's an estimate that it actually comes down a little bit. I think that's more numbers removing or adjusting than anything that I would take as concrete example of it going the other way, of true unemployment coming down significantly. I think we're just in slow growth morass at this point right now. You're hearing it again, and I've talked about this repeatedly about the K-shaped economy and those kinds of things that are just giving employers a little bit of pause in adding aggressively to staff, especially as they try to figure out what artificial intelligence does for their productivity without adding a lot of incremental staff. We'll see where this ends up, but I do think we're going to be in a slower growth morass here, especially in the job market, for a little bit. I'll talk more about this tomorrow or later on this week when I release my 2026 earnings, market update and outlook piece. We'll talk jobs more robust fashion then, but we do have a number Friday. Again, 1 point does not make a trend, so we have to understand that, but we'll be watching it to pay attention to see if things are slowing further than we anticipated or maybe even a little bit better. Turning to number three, earnings growth for 2026. We haven't hit the big earnings companies yet. That starts next week. So we'll talk more about earnings for specific companies coming up next week. But I really wanted to talk a little bit more about the usual trend of the early part of the year. Right now, 2026 earnings growth estimate is for 14 plus percent, 14 and a half, I think, somewhere around there. That's pretty high. That's higher than long-term averages for earnings growth in the S&P 500. What you usually see in January, though, is usually you see that number come down. That growth number usually comes down. The estimates start to decline a little bit from where they've hit. What we saw in 2024, or excuse me, in 2025, was a little bit of during most of the year, it came down early and then it kind of flatlined for a while. Towards the end of the year, the estimates were starting to rise a little bit. I think that had to do with some tax relief, some adjusted company discussions, these kinds of things. What usually happens in 2026 or in any year, in the beginning of the year, is companies will want to give estimates that they can beat down the road. So a lot of times in Q4, what you'll see for Q4 earnings, which happen now, you'll see them report the year and then they'll provide their outlook for 2026. Well, again, it's a game that Wall Street and companies play a little bit is they want to issue earnings numbers that they can exceed. And as a result of that, sometimes they'll bring those estimates down and saying, hey, you guys are expecting this. Well, we could come in at this level. And, we're looking at maybe, a little bit slightly sub-average growth and these kinds of things in the hopes that they can beat those numbers going forward. And Wall Street plays their part in the game and they bring the numbers down. More years than not, that's what this happens, is that usually it's a pretty high point later on in the year for the earnings estimate for the following year. And then it starts to come down a little bit. How far it comes down is usually the bigger question. If it comes down to 14, and we're still at like 12 or 11 or even 10, still a very, very good backdrop for the markets. And I think we can actually do that. The bigger question is if we start to see a change of pace. Again, I talked about companies being a little bit more cautious in their hiring stances. It doesn't seem to be related to significantly soft demand as of yet to where they would bring their numbers down aggressively. Now, we could absolutely be wrong there. That could be what they're actually seeing and why they're not hiring as aggressively. But we don't have any indication of that as of yet. We'll learn more about that in the coming weeks. But from our side, I think they will still try to set numbers that they can beat for the year. So they will probably be somewhat conservative in their guidance. And therefore, that earnings number that is 14% probably does come down. The only real issue is if it comes down more to where you start to talk about mid to low single digits or especially declining growth. Now, I don't think there's a scenario at this point right now that would suggest that we're going to be anywhere near that anytime soon. But if that were the case, if something were to happen to have, substantial weakness to turn that over, especially given the valuation of the S&P 500 right now, which is expensive. We are high. And again, I'll talk more about that in my update and outlook piece coming up this week. But we are high in valuation right now. So you kind of need earnings growth support to keep those valuations up. If we start to trend the wrong way, you could start to see that double whammy of both earnings coming down a little bit, but also the valuation of what we're paying for that coming down as well. That's a recipe for not a great market. I don't think we're there as of yet, but it is something we'll be watching over the coming weeks. Turning to the personal side, I have never had much interest. I think this is a function of me getting older, as I never had much interest in green thumb activities, planting, planters, flowers around the house, those kinds of things, until recently. So last year, I bought my wife one of the arrow gardens that are the indoor gardens that you can make things, and it has a little light over the top, and you can grow in the winter. I live in Minnesota. Winter is white or brown. That's all you really get. You don't get a whole heck of a lot of green. So we've had that for a year now, and to be completely frank, we haven't used a ton of the herbs, but we have had green consistently in the house, which has been nice. I really like it. The smell is different and that kind of stuff. So I took a shot this weekend and went and, I wanted to just buy grass for a planter behind in our kitchen windowsill. Well, in true Jeremy fashion, I overbought and I bought a boatload of grass. So I ended up going buying more planters so I could plant that, bought a couple of plants to put in there with them to try to spruce it up a little bit. And now all of a sudden, I think I have a green thumb. I do not. We will see how this experiment holds. But I did say, playing in the dirt and getting the green, getting the smell, it was pretty fun. So I don't know if this is a function of getting older. I don't know what it is, but I enjoyed having a little bit of an exercise in building planters, and it may be something I continue to do in the future. We'll see. All right, that's all we have for this week. Tune in in this coming week, we'll have our market update and outlook piece where we'll reflect on what 2025 held and also what 2026 looks like and kind of update to our path forward. But until then, we'll have our regularly scheduled programming of IndiView. But until then, thank you very much. Take care, everybody.